Is it the best time to trade forex, Pete?
It's always the best time to trade forex. 252 days a year, even if you could get it on Christmas. Call me, I'll make you a price.
Compliance officer is just has thrown his screen out the window.
Bashing his mouse on his table right now.
Well, this is always a matter of opinion. It depends on what you're trying to get done in any asset. Is it the best time to trade stocks? Well, do you just long stocks and hope that they go higher, because then the least volatile market is the best time for you to trade stocks?
Right.
If you're a day trader who's trying to take advantage, or a swing trader who's trying to take advantage of intraday or day-to-day large moves in forex or stocks or whatever you trade, then a volatile environment tends to be the best one, and a volatile one being one that gives you the most prices per time frame, per hour, per day, per week, whatever time frame that you're actively trading in. You want as many different prices, as many different new levels that you're not used to seeing, whether you're trading momentum or you're trading contrarian against the trend. You just want big swings. And if that's what you're looking for, if you are an active trader, the forex market is giving you some of its highest volatility in the last 5 years plus. I crunched the numbers here, Pete, and we're looking at realized volatility, actual volatility.
That's old school Aussie vol. We haven't seen Aussie Kiwi vol there. Traditionally, it sits 2 to 3. It used to sit 2 to 3% above Euro vol.
Okay, so probably in the 6, 7, 8% range.
Yeah,
maybe getting up to 10.
And then we had that weird time where it was actually below Euro vol, which is really something. But this is outsized vol.
The numbers themselves, if you're looking at the today column, are pretty high. We tend to see single-digit volatility pretty much across the U.S. dollar major pair board. Now that Aussie and Kiwi and some of these commodity currencies can get up to 10 or 11 or 12% volatility, even if we're not in a crazy market environment. But we haven't seen that in a long time. And now we're talking about 20% volatility in Aussie, which is, I mean, if you crunch the numbers on S&P 500 vol, they're not usually at 20%. Of course, recently, they're well over 20%. If you're looking at VIX, we've seen 30% plus prints the last couple of weeks. But 20% in a major U.S. dollar forex pair, very rarefied air, 17% for Kiwi. Interesting one here, and maybe the most abnormal on the board, Swiss franc vol is up to almost 17%, and that's actually the only major U.S. dollar pair that's higher than its pandemic highs in volatility. As you can see here, during the pandemic, the highs in volatility for these pairs, 24% in Aussie, 23% in Kiwi. So we're not there, but we're very close to there. And if you're looking at the Swiss franc trade, we're actually surpassing that volatility. So this is to say a very volatile environment, the most volatile one since the pandemic. And for some of these pairs, the Swiss franc there, a more volatile environment than the pandemic.
Absolutely.
And I want to go a little bit further with these numbers just to show you here, when we look at realized volatility rank, this is saying, okay, over the last year's worth of volatility data for these different pairs, where are we sitting in that range? And an RV rank of 99% or 100 tells you that right now is the most volatile time in the last year. And you can see that we're at that peak for almost all of these US dollar pairs, actually except for CAD, which if you'll remember, they kind of saw the highest vol that they've seen in the last year when the tariffs started in March. That was when Canada was really the focus of the Trump tariffs. And so 77%, it looks weak. It looks like, oh man, it's not that volatile, but still kind of keeping pace, at least, and still a volatile one.
They're all pegged at their highs.
It's craziness here. And I want to go one step further, because now you might say, okay, well, Pete and Frank, it's nice that you've shown me all these volatility numbers, showing me that it is right now the most volatile that it's been the last year for a number of these markets, and for some of them even more volatile going back to the 2020 outset of the pandemic. I can't trade these numbers. I'm not trading variance swaps, right?
What does this give me?
Well, so you are trading the price action if you are day trading or swing trading these forex pairs. And so what this translates to is standard deviations in all of these pairs. And what's a standard deviation? Well, it's the range that the recent data tells you the market has lived in 68% of the time. So a decent amount of confidence. And what a lot of people look at, it's what most options traders look at when they're looking at one standard deviation. Okay, I'm looking at the 16 delta. Of course, you could say, oh, well, I want greater confidence. And that might be a 2 standard deviation move, 95% confidence. That's the range that I want to trade. Well, it's rare that a market gets outside of that range. So a lot of traders look at 1 standard deviation, 68% confidence, because that's a healthy amount of, okay, that's the majority of the data, but it's still allowing for some outside movement, right? Because if you're trading the trend and you're saying, okay, I want to look at this market when it gets to, an outside level and trade it beyond that outside level, well, you have to have some occurrences of that market actually getting to that outside level. And so if you have a confidence interval of 100%, it's never getting beyond that. 68% is pretty much an industry standard, 1 standard deviation that a lot of people look at for trend followers, looking for, okay, it got to that boundary and now I want it to go outside. Or contrarian traders will look at that boundary of 78 points in Aussie and say, okay, well, when this market gets to 70 or 80 points up or down, I'm looking for it to revert back into that range. And you can see here, Pete, these 1 standard deviation moves are a lot healthier than they've been the last
in November,
year
we were
or two.
looking at stuff in the 30s, and I think euro ticked down to 28. So,
Euro dollar range closest to 100 points than we've been in so long,
which
at
is
82
great,
points.
This is a great metric for determining what's a normal day and start to determine, okay, this market's moved far enough, and you're using statistics. I mean, a 68% confidence level tells you you're going to be wrong 32% of the time. That's why we think about risk management. And again, good times to trade, wouldn't fall. And I think you make this great point. More unique price points give us more opportunity to decide where we want to get in, get out. Obviously, I was kidding when I said every day is a great day. It's all relative, but this is great if you can put context. As a trader, we didn't have any of this math. The hardest thing is when structure in the market changed, like what we've seen in the past 3 weeks, it took us a while to start to understand that by getting run over, because our expectations were, well, fading 40 points on either side of unchanged was always a great trade.
Sure.
And then it was like, they didn't even look as they blew by that.
Yeah.
Looking at these are great tools to let us start to make better decisions with the fact that the market's dynamic. Sometimes it gives you more, sometimes it gives you less.
And we'll be updating these constantly and coming to the show with them. But just as a last piece here, our friend Glenn put together a great graphic of what you can do on your charts to kind of look at, and this is dollar yen here, when this market has moved, in a given day or in a given number of a couple of hours, this 1 standard deviation move. You have all the numbers from our last slide. Now you can go to your charts and take a look. And
this
really
is a
interesting.
Nice tie-in
the last couple of days here in this dollar yen, we've seen the 125 point moves, but haven't really broken outside of that range. So great trade for contrarians.
On either side of it.